Hello and welcome to another episode of our consumer education series, Nivesh Befikar, presented to you by your trusted brand Policybazaar.com. In the last 4 decades, Indian economy has grown manifold because of the immense industrial production, higher employment, labor productivity, and technological innovations. The UN said in its mid-year update of the World Economic Situation and Prospectus that India is going to be the fastest growing major economy. In the last 1 year, India's growth story has been very strong. It has outperformed not just developing but developed nations also. Ideally, there isn't a right or wrong time to invest in markets. If you keep on delaying investing, then you may lose out on the wealth gained over the years. To help you understand why you must start investing now in India's growth story, joining us today is Mohit Vasudeva, NRI Investment Head, Policybazaar.com. Welcome to the webinar, Mohit.
Thank you. Thank you so much for having me here, and hello to all the attendees today. I hope everybody is keeping safe.
So COVID-19 is not out of the woods yet, and we are now experiencing the threat of third wave. What are your views on the current market performance? Will it sustain, or what we can expect in the coming time?
I think, Shreya, from a threat perspective of the third wave, it was already anticipated that markets will not take a plunge like we did in the first or the second wave. The good thing is, even if you look at Sensex as late as this afternoon, it is still at a high of about 61,000. So whatever correction had to happen has already happened towards the end of December. I think what we're seeing now is the new normal, and the only way we have from here is upwards. So it's a good sign. The best part about this is that with the third wave coming in, the world, the Indian economy, us as people in general, we were better prepared. We already knew that, we might have to go back into a work from home situation. So industries did not shut down. For instance, if you look at transportation or the car market in general, car sales are at a high at this point since the last 2-3 years. You look at IT industry in general, and I'm sure a lot of you would have experienced that. Instead of losing jobs this time around, we've got scarcity of people. There are more than enough jobs in the market, and people are switching like how. So all of these are good signs. I don't think the third wave will have any impact on the market. And I think if you could allow me to share, I can actually show what some of our experts are actually talking about with the third wave, or how do we foresee this market in the coming days. In the interim, I think for the audience in general, what we must understand is that while the COVID cases in terms of count is far higher than what we've seen before, the mortality rate is much lesser. How that has helped is that, one, the fear of mortality has not led to people anticipating lower business volumes and lower returns, and hence the market hasn't kind of plunged. But on the contrary, what has also happened is that with the fact that people were already aware, work from home became a culture. So I'm sure a lot of you who are on this call are working from home, and what that has done is that business is actually not stopped or not even dipped by a few basis points. I think which is a good sign. Sure, it's okay if you're not able to share, we can continue. I think we should be fine. For the audience, I think what you could do is if you read the Economic Times, or if you are able to find articles on money control, you'll see that Rakesh Jhunjhunwala, Ramdev Agarwal, even Morgan Stanley are expecting the markets to rally. Instead of seeing a downfall, what you can expect is that in the next couple of years, the market should rally upwards closer to 80,000, or even beyond 1 lakh very, very soon. So if you are somebody who's keen to invest in the market, it isn't a bad time. In fact, it's a very, very good time.
Okay, so it's a hard fact that investment reap better returns over a long period of time, and India is poised to grow into a 5 trillion USD economy by 24-25. What is your suggestion to the customers in order to make the best out of this opportunity?
While everybody understands that India is currently expecting a bull phase, because we are now closer to 2 trillion, and This is exactly when we saw China or United States pick up and went to 5 trillion, where we're around that mark, and actually we're actually closer to about 2.8 trillion as we stand today. There is always one thing that people need to be wary of, and that investment is always a long-term story. Nobody gets rich overnight. There can obviously be exceptions, but in general, if you're going to invest money in the market and if you're looking for good returns, you should at least have an 8 to 10 year horizon. How we say that is that if you look at any point to point return from any date to any date over a period of 8 to 10 years, in the last 50 years of the Indian market, you will only find that money has grown. You will never find anybody at loss. So pick up any date and look at the market from that point to the next 8 to 10 years, you will only find that market has grown. So no matter what time you enter into the market, one, I think you must ensure that if you've invested into a plan, you continue with that investment so that you don't break off in between. Two, have an 8 to 10 year horizon before you pull out the money and allow it time to grow. I think that's pretty much the mantra of investing.
One of the greatest advantage of investing in India is the range of options available for investing your money. So could you please list down a few options or investment avenues for our listeners also?
Insurance perspective, I think broadly I would categorize investment into two different types. One is guaranteed returns. Now guaranteed returns are, while similar to FDs, but there is always that additional element of life insurance that is attached to it when we talk of investment in the insurance market. What happens is that you start paying money as of a certain date. You lock in for a certain period of time, but the best part is that at the inception of the policy itself, you know exactly what is the return that you will reap after 10 years, 15 years, or 20 years, whatever the time of the policy is. The best part about guaranteed return plans is that you have the ability to, one, get life insurance attached to it. Two, and I think this is something very, very important and very recent. With the increasing returns on government bonds, insurance agencies or investment insurance companies are now have the ability to give you more returns, far higher than FD, and all of these returns that you get when you get these proceeds are tax-free. So broadly, if I were to list in this particular category of guaranteed returns, 3 points. One, returns will be higher than FD. Two, they are assured at the time of policy inception. Three, the returns that you will get will be tax-free. And if you're an NRI in particular, when you're paying the premium, Policybazaar along with the insurance companies has now made a paperless journey which allows you to also get GST waiver on these policies. So imagine if you're going to pay 1 lakh rupees or 5 lakh rupees at the start of a policy in the first year, and that's what you will be paying for the next 5 years. You have the ability to on that 5 lakh rupees at the time of payment itself. That's an added advantage if you're an NRI and paying through an NRI account. And all of this process is paperless. That's one part of investment. The other is market-linked returns. Now, market-linked returns are equity-based, and obviously they carry a certain element of risk along with it. That said, with the point that I made a little while earlier, that if you're okay to invest for a horizon of 8 to 10 years, I do not see any reason why you are somebody who is under risk. The best part about Ulips versus a lot of other options that are there in the market, like mutual funds, etc., is that again you get life coverage from day one as soon as the policy is issued. When the market is, let's say, correcting itself, you have the option to switch funds, and most of the insurers today allow you to switch funds without any cost. Three, again, because this is an investment or an insurance product, you will have benefits under ATC at the time of investing the money, and the majority proceeds will also be tax-free under Section 1010D. So again, three very, very important things to remember. One, you will get life cover along with the market returns that you can anticipate. Two, you will have tax benefits at the time of investing and at the time of maturity. Three, depending upon the market, you will be allowed to switch funds, which is something that you do not get with mutual funds or other options, because in that case, either you are forced to exit the market at whatever amount you are getting, or there are exit charges along with it. Here, fund switching can be absolutely free, and you can move from mid caps to large caps to debt funds depending on the market situation. One additional thing, and this is more important for people who have this thought in their head that, am I okay to lock in for a period of 10 years? Ulips also allow partial withdrawals after 5 years. And there can be multiple withdrawals that can be made depending upon your requirement. So if liquidity is a question in your head, Ulips will also allow you to extract some money out of the funds that you've invested post 5 years. I think very, very importantly, what I would want the attendees to understand is that you would have always heard that you should diversify your portfolio. You should have some guaranteed returns. You should have some market-linked returns to match. Policybazaar, along with the insurers, has put together a combination of this for the ease of our customers. Instead of you having to calculate what is the right mix, we've introduced capital guarantee plans, which if you were to speak to our sales team or our advisors, you would hear of. And what this capital guarantee plan does for a customer in general is actually multifold. One, the amount that you're investing over whatever 5-10 years is 100% secure. So by the name itself, as you can understand, the capital that you have invested is guaranteed at the time of the end of the policy term. Two, there is always a market upside that you will receive by virtue of market-linked returns. Though this may sound a little muted when you compare it, but that is actually the percentage that you're giving away in order to ensure that your investment is risk-free. That said, there are insurance companies that we're working with that give us as high as 17% or 16% returns even in a capital guarantee solution, which is a very, very healthy return. 3, you get life cover from day one throughout the policy term since the time that your policy is issued. And 4, tax benefit continue here as well. So at the time of investing, you get tax benefits under Section 80C, and at the time of returns, you get tax benefit under Section 1010D. So I think for first-time investors, this is the best possible option. It allows you to diversify as soon as you enter. It also ensures that the capital that you've invested is risk-free, and that at least that particular amount has a sure shot return at the time of maturity of the policy. And you also get market upside as the market moves upwards. But like I said, again, what is important to remember is that you pay and stay, have a horizon of 8 to 10 years at least.
Okay. So let's move to customer queries. Our first question is from Ishad Khan. He asks, which is the best short-term investment schemes which provides good return and are secured?
I think, like I said, when you say short-term, how short is that term is what would define it. Now, the shortest term that I can imagine, while there are plans which are as little as you pay for 5 years, or you pay a single pay and stay invested for 5 years, that period is not enough for you to allow your money to grow. If you're okay to pay for pay a lump sum in one go, or pay for 5 years and stay invested for 10, there are multiple Ulip options that are available for you. If you're looking for aggressive growth, you can some of the insurers that you can look at are Tata AIA, Bajaj Allianz, HDFC Life, Max Life, ICICI Prudential, multiple options, and all of these have performing funds in the mid-cap category. You can decide on aggressive funds. You can also decide on some of the debt funds to kind of ensure that your returns are safe. So you can depending on what your exact ask is and how aggressive are you about your returns, Ulips I think would be a good option, but which one we would only be able to discuss and help you better.
Our next question is from Uday. He's asking, just like insurance is regulated by IRDAI, does these investment plans also come under IRDAI, or there are some other regulatory body?
No. So these plans fall under the insurance umbrella. So these are also regulated by IRDAI. It's the same regulating authority. Like I said, the difference between investment plans by insurance companies versus mutual funds is the fact that there is a life insurance element involved, and because of that, it is regulated by the same regulating bodies.
Our next question is from Aravind. He is asking, what is the difference between long-term investment and short-term investment? How does it work on the parameters of risk, ROI, etc.?
Both in terms of risk and return on investment or return on yield, I think long-term investment work better, simply because you allow your money to stay in the market and get more exposure. Over time it gets more exposure, and by virtue of compounding, you can always expect more and more growth if you are invested for a longer period of time. Irrespective of what you've chosen, a short-term or a long-term investment, you're paying money for a certain number of years. For instance, if I were to buy a plan where my pay term, which is the number of years when I'll be paying money, is 5 years. The input is for 5 years. Hypothetically, 5 lakh rupees for 5 years, which is 25 lakhs over 5 years. Now, if this 25 lakhs is invested in the market for five more years, which is another additional 5 years after the payment term, my exposure to the market is lesser. If you just understand compounding, how it works, the more number of cycles it will go, the more possibility of increasing your money or growing your money. So short-term investments are good when you have additional money for immediate growth, but I think for all life stages, and this is the core fundamental of investment. When I talk of life stages, what I mean is everybody, including you, me, all the attendees, everybody that we will ever meet, fundamentally will have 2-3 goals in life. The first and foremost for every working person is retirement, which is obviously a long-term goal. The next is, depending on how you believe in this, is marriage or children. That again that can be both a short-term and a long-term goal. So marriage can always be a short-term goal, because if you're starting to earn at about 25, you're maybe looking to get married in the next 5-10 years. So that's predominantly a short-term goal. But children, and when you say children, you can have both short-term and long-term goals. One life stage is childbirth, the other is child education. So if you know that you will need money after 20 years, obviously a long-term income plan or long-term lump sum plan is a great option. And when I'm talking about these fundamentals also decide what kind of investment you should look at. For instance, if I am talking of retirement or a child education, I already have a rough mathematics in my head as to what is the amount that I will need on retirement per month, per year, or same for the education of the child. And this is something that is non-negotiable. So when you're talking of these two elements, I think first and foremost, you should ensure that you have a guaranteed plan in your portfolio, because then that amount is secure. And you know that if you need, for instance, say 10 lakh rupees a year after 40 years or 30 years, that should be secure. That 10 lakh should not waver. Once you've got that settled, you can then start investing in the more, risk. Actually, risk is probably not the right word, but equity exposed options in the market, where you can, now that your retirement is settled, you can say, okay, now I want to buy a bigger car, and maybe for that I need quick money in the next 5 years, and I can look at maybe investing in a Ulips and say, well, why just settle for 8-10% return? Let's try and aim for 20% return. Allow it to give some, have some exposure and some risk as well. So I think that's what you should be comfortable with, and that is how you should ideally decide what plan to go for.
Which ULSS is having higher term rider coverage for NRI? Which option is good to take separate term insurance or take ULSS combo?
That is actually a very interesting question, and I think very, very good question to be short. See, both term and investment options or investment insurance options have their own purpose in our lives. I think with COVID, life cover has become extremely important. And I think that knowledge has spread not only across the globe, but particularly in India, which is a very, very young market for life insurance. So like I said, both have their individual purpose to serve. If you have a sizable life cover, which means that there is a certain amount that you have already saved aside, or thought of saving aside in case of an unfortunate event, I think you can always invest in Ulips, because what you think of as a good amount today, with the inflation rate being to the tune of 6, 7, 8% or even more, depending on where you are, or less, that amount may not suffice for your family after 10 years, 15 years or 20 years. The best part is that while Ulips have the capability of giving you returns almost equivalent to stocks or mutual funds, they keep on adding to your life cover simultaneously. So in the case of an unfortunate event, before the policy term is over, if in case your family needs, at least that amount additionally will be paid to your family. So, with the way things are in the world today, I think Ulips definitely come out as a better option.
Our next question is from Sibi. He is asking, I am 52 years old and I already invested in stocks, mutual funds and permanent income plan. So now I need to invest in lump sum amounts. So what are the best options available?
I think you should then, and maybe because you're at that age, and I would personally recommend this for everybody, towards the later halves of your lives, when you're 55, 60, 65, please look at the option of investing into an annuity plan if you have lump sum available. Couple of reasons for that. One, investing in an annuity plan assures you a certain return, and this return comes as monthly income to you. So your expenses of your daily lives, of your regular living does not stop. In fact, it can only help your lifestyle. Two, even if that part is covered, getting this regular income can help you reinvest this money and compound it again by means of a smaller SIP plan. So imagine if I were to invest 50 lakhs today and start getting an income of hypothetically, 30,000 from next month. 30,000 would be probably the right number, and we'll have to do the math though. But roughly 30,000 from next month. If I need this 30,000 for my daily usage, that is available. In case not, I can always use this 30,000 every month to reinvest in Ulips, or maybe to try my hands on more stocks or more mutual funds, and at least that gives me that freedom. So towards the later half of your life, if you have money, I think annuity is a great option.
So next question is from Deshmon. He is asking, I would like to do a lump sum investment of 25 lakhs. What would you recommend for a short term of 5 to 8 years?
For a short term of 5 to 8 years as well, I think you can always, depending on what is it that you want to achieve at the end of this, you could split it between guaranteed as well as Ulips. You could invest it all in a Ulip if you're okay with allowing some risk, and you want aggressive growth of your money. And if you have already thought of why this money would be required after say 10 years, guaranteed options would be a good option again. So depending on your age and your requirement, we can definitely help you. We have options across the board for the money that you're thinking of and for the term that you're thinking of. If it is going to be 5 years, I would then recommend that you kind of split it into a year, or with multiple partners, or you could even do it as one lump sum as well.
Our next question is from Dheeraj Khanna. He is asking, what would be the maximum tax benefit one can get while investing? Which schemes provide maximum tax benefit?
Tax benefit is available for all investment products provided by insurance companies under 80C and 1010D. While with the last iteration that was made in the budget, I think Ulips are limited to an amount of 2 lakhs in a fiscal year. But sorry, Shreya, were you saying something?
Yeah, no, I was saying it was 2.5 lakhs.
But I think when you, sorry, I'm just getting some pop-ups on my screen. What I was saying was that while ADC is one option that kind of limits the amount that the tax that you save, but under 1010D the amount doesn't have any capping, so the returns will always be tax free in such a scenario. So it is the same across 10-10D is the same across Ulips or guaranteed plans. So that is something we need not worry about.
Our next question is from RM Fernandez. He is saying, being NRI based in Saudi Arabia, where do I invest at the age of 60?
At the age of 60, I think you're very, very close to a point where life insurance may not be available. If that is something that is of urgent requirement, or if you would like to invest with life insurance, let us quickly get you invested with a ULIP or with a guaranteed plan. But like I said, I think at the age of 60, and I'm assuming you would have had some lump sum ready, with you by now. Annuity would be a great option. It will ensure that you continue to get monthly income or annual income the way that you want it for the rest of your life. And please understand that in an annuity plan, at the end of the policy, which is basically at the time of death of the person who is the policy holder, the amount also gets paid back to the nominee. So the amount that you're investing today will also eventually come back to the nominee, and for the time that you're alive, the amount keeps coming to you as income every month or every year as you choose.
So Shri Ram is asking, kindly advise and suggest on systematic withdrawal plans.
Actually, that is very interesting. Most investment plans usually give you the option to select at the beginning itself if you want your returns as a lump sum or as an income towards the end. Now, if you're looking for income plans, for a longer period of term, I think we have some great plans by insurers like Tata or HDFC or Bajaj, for that matter of fact, and including Max and iPro and others, where you can assure your returns today to the tune of 5.5% as well, or closer to that, which basically means that you can pay a certain amount today and get a guaranteed return monthly or annually for up to 40-45 years. So that is something that no FD, no other guaranteed solution in the market today can provide for such a long term. Practically 45 years for most people, for most of the average population, is a lifetime. And to think of it myself, I'm saying that if I'm 35 and I can assure my returns for 45 years, I'm nearing the age of 80-85, which is the best possible life expectancy. So I think that would be a good option if you're looking at systematic returns on a monthly or annual mode.
Our next question is from Mohammed Hussain Shah. He's asking the best joint pension plans with and without cover with return of purchase price in 12 to 15 years. Can be a mix of many plans as well to pay an average of 50k INR per month. So he's asking for plans which can pay him a pension around 50k per month.
Depending on the money that you're okay to invest, most plans can pay you a pension of 50k a month, even more. But if you're looking for a joint life option, I think that kind of limits the search a little bit. Also, you said you want return of purchase price in about 12 to 15 years, is it? So you could actually look at a mix of options, or you could even look at a joint life plan from Max Life or from HDFC Life, if you're keen on that. But like I said, some of these questions are actually very, very specific to the person who is investing, their age and their specific requirement, and how okay they are to allow their money to be at risk in terms of the open market. So I think it'll be unfair for me to give you a particular insurer name or a plan name immediately to invest, because that may be biased because of the way that I think about myself. But yeah, you can always explore options from Max. That comes at the back of my head. Max has an SWP plan that is available with joint life. It has income for whole life and life cover for both. So that practically covers for everything in one go.
So we had a question of PN Patil. As of now, I am 50 years old and both of my kids are doing college education. Which is the best short-term option for me? He has shared his details, in which he is saying, I am looking for 5 to 7 year plan, and I have to invest around 10 to 15 lakh in next 6 months.
I think we can then look at maybe a couple of single pay options with some of the better insurers like Tata, Bajaj or HDFC. where you can ensure that even if you're not able to invest for, let's say, 8 or 10 years, you have the ability to withdraw amounts starting from 5 years. You can definitely look at Ulips. It will also ensure that you get some life cover, so that in case of an unforeseen event, your family or your nominees, which in this case ideally would be your spouse or your children, have money to ensure that the college education or whatever the plans are in the future don't have to suffer.
Our next question is from Sanjay Batra. He is asking for some plans for people nearing retirement.
Sir, if you already have a guaranteed source of income, I think right now is just about the best time to get into the market and stay in there for about 15-20 years, or maybe even 10 to 15 years, where you pay for about 5 years or 10 years, and then you allow your money to grow for additional 5 to 10 years. Now, in that case, some of the plans from Tata, from HDFC, from SBI, from iPru are a great option. But if you do not have something that is assuring you guaranteed income post-retirement, I think the first thing that we need to get done is that we get you invested in an income plan, so that post your retirement, you have money coming in for your daily expenses. Alternatively, if you, like I've been saying, if you have a lump sum readily available, please look at the option of an annuity. It will ensure that you continue to receive money as a monthly income or an annual income throughout your life. And upon your demise, your nominee gets your lump sum back as well.
Okay, so Karan and Andy both are asking this question. How are these investment plans better than shares and mutual funds?
I think the first and foremost reason that I believe that in the current scenario, these would be better than, and please understand, it is not a matter of better, but it is a matter of choice. And why I would say this should be your first choice is because of the fact that there is an element of life insurance attached. I think the last 3 years have taught everybody that life insurance is extremely critical. And while it is a good thing that you allow your money to grow and everybody wants more and more money flowing in case of an unfortunate event, your family, your nominee, whoever that be, requires money to survive for the rest of the term of their lives. And this life insurance element covers that for you. So that is the reason I believe it will be a first choice. But other than that, even if you just look at it from a returns or a tax saving perspective, some of the insurers over the last 2 years, 3 years, 5 years have given returns which are at par, or when you look at individual funds, sometimes even more than mutual funds. So you're not losing out on returns. The benefit that you're also getting is that you will save tax under ATC and 1010D. So if your returns are tax free, you obviously end up receiving more at the end of it all. So your net return or return post tax is definitely higher when you invest in Ulips.
So our last question is from Karan Modi. He is asking, as per some experts, market is currently in the bull run, and therefore we might see high returns in short term. It is expected to see correction by end of 2022. So do you still think Ulips can provide good returns if we invest in bull market?
The whole idea of a bull market is that we expect it to go to 5 trillion. So if we're at 2.8 and if it goes to 5 trillion, I don't see how a correction is going to happen in the middle. And please understand that by far right now, or the last 24 months have been the worst possible scenario that we've seen in a long, long time. Pandemics happen over a course of 10, 15, 20 years. And I think after Ebola this time around with this pandemic, we don't foresee a lot of correction in the future. See, correction, like I said at the beginning of this conversation, whatever correction that was supposed to happen, I believe has already happened. The only way from here for the market is upwards. And while there will always be some amount of peaks and valleys in the market, a little fluctuation, but that is the reason we always recommend that you pay and stay over a long period of term. There is no way that you would end up losing money. And yeah, back to the question again, by virtue of this being a bull market, please expect it to double. The fact that it's going to double is why we are calling it a bull market.
Okay, so our next question is from Andy. He is asking, how can we strategize our investments that they hedge themselves against all market downfalls?
Diversify. I think first thing first, please ensure that you have a certain amount guaranteed for yourself, so that it is not, you don't end up at a point where whatever you've invested is seeing a downward trend. 2, ensure that whatever you're investing in terms of equity or in mutual funds or whatever you choose is for a longer horizon. Don't be in a rush to pull your money out, because if you systematically keep investing, you get benefit of the market irrespective of at what point you entered. And like I mentioned before, over a period of 8 to 10 years, the market has always seen growth. There is not one point in history over 8 to 10 years the market was lesser than where it was before. So those are 2 very, very key things. 3, if you've chosen a monthly investment plan or an yearly investment plan, continue investing and stay with it. The problem happens when people, out of fear of the market correcting, move out of the market, because then whatever little you've already invested also kind of moves into discontinuance fund where your returns are lower. So you don't stand a chance to make enough money. So be persistent about it. If you started investing, continue to invest. Have a horizon of 8 to 10 years, and remember to diversify.
So now I think it's time we should wrap up the session. But before wrapping up, Mohit, quick advice for our listeners, keeping in mind the current market scenario, what they should do with their investments.
I think there's no limit to the number of times I can repeat this. If you guys have already put your money in the market and you're on a plan, continue investing. Do not stop. Ensure that your horizon is longer than 8 to 10 years. But if you're somebody who is risk adverse and does not want to take a risk, I think for those people, like this is practically the best time. This is something we did not discuss a little earlier. I did mention that government bonds are giving the highest returns. This is the best time to get in with guaranteed plans in the market if you don't have one at the moment. For your retirement or for your long-term goals, ensure that you invest in guaranteed plans with the insurers. The returns are high, they are tax-free, and only investment products in the market today can give you returns for as long as 45 years, or assured returns for as long as 45 years. That's one thing. 2, I think let's not be worried about where this market is headed. If the market has the ability to survive a wave 3 of COVID, only corrected a little and then stabilized, and if you look at the last couple of days, it started moving upwards again. Even if certain corrections will happen in the coming years, over a period of 5, 7, 10 years, the market will only grow further from here. You can expect your money to grow along with it. So let's not fear that, at least.
Thank you so much, Mohit. It was a very insightful session. You can send in your queries at Policybazaar show@policybazaar.com. Thank you so much, everyone. It was a pleasure.